Now that we have covered the standardized terms of the option contract, let's take a deeper look into some of the associated terminology. One thing to note is that many option concepts have synonymous terms. For example, an option buyer might also be called the holder or purchaser of the contract, and the option seller might also be called the writer of the contract. We point this out because we will be using these terms interchangeably throughout our curriculum in order to expose the learner to all aspects of the appropriate terminology. Investors know that buying stock entitles them to partial ownership in the corporate entity issuing those shares. In other words, you are purchasing an equity participation in the company. Most stocks listed and traded on U.S. stock exchanges are known as equity securities. What is an option then? As we previously discussed, an option has terms and conditions just like any other contract. Unlike stock, however, an option does not convey to the purchaser actual ownership in the underlying financial instrument. Instead, an option contract conveys a right to its owner to buy or sell shares of the underlying financial instrument upon which it is based. The options we will be talking about in this course are based on equity securities such as stocks and are thus referred to as equity options. Lastly, the options that we will be discussing in this course and all others will be based on publicly traded and exchange-listed equity options. Many companies offer stock options to their employees directly as part of their financial compensation. These options are not listed or traded on any public options exchange. Further, this type of option contract is between employee and the employer, and as such, we will not be referring to these types of options in these courses. Click on the video below to learn more about publicly traded and exchange-listed equity options.
So what are options? An option is a contract that gives the owner the right to buy, in the case of a call, or sell, in the case of a put, an underlying asset. A regular equity options contract is for 100 shares of stock, and that stock is called the underlying. Let's go over some important terminology. Holders, also known as buyers, are investors with long options positions. If you are long an equity call option, you have the right to buy 100 underlying shares at any time prior to its expiration date. If you are long an equity put option, you have the right to sell those 100 shares at any time prior to expiration. The writer of an option is an investor with a short option position, and option writers have obligations. If you are short a call, you have the obligation to sell those 100 shares of stock at any time prior to expiration if a call buyer exercises his or her right. On the flip side, if you are short a put, you have the obligation to buy 100 shares at any time prior to expiration if a put holder exercises his or her right to sell that stock.
Let's define the option contract a little further. Equity options, like stock, are classified as securities. More specifically, equity options are derivatives of a security. As explained earlier, this term implies that their value is in part based upon or derived from the value of the underlying stock. As securities, option contracts are available for trading on any of the options exchanges in the U.S. that list equity options. Similar to the stock market, the SEC oversees trading of all exchange-listed equity options in the U.S. marketplace. To the investor purchasing and holding an equity option, the contract conveys a right to either buy or sell shares of the underlying stock. To the investor selling an equity option, the contract conveys an obligation to either buy or sell shares of the underlying stock. There are two types of standardized equity options, calls and puts. As we learned in Module 1 of this course, a standard equity option conveys a right, not an obligation, to its holder to purchase 100 shares of the underlying stock at a specific price per share, known as the strike price, on or before its expiration date. A standard equity put option, on the other hand, conveys a right to its holder to sell 100 shares of the underlying stock at the strike price on or before its expiration date. Click on the video buttons below for a deeper dive into buying calls and puts.
Perhaps you're an investor with an optimistic opinion on a stock, index, or ETF.
Do this one separate so it's not such a long video.
So, let's say that you're ready to buy an option, but the question is, who's going to sell it to you? The seller will either be a person who had purchased the option previously and wants to reduce or liquidate or close out this position, or a person who has no open position and who chooses to create or write it. These individuals can be professional option traders and are employed by trading firms, typically known as market makers, who are members of an options exchange. These trading firms provide a two-sided market, commonly referred to as a bid and ask market, for each option series of a specific underlying stock. Other participants may include institutional firms like hedge funds, banks, or simply individual investors like you. However, when buying a call or put contract, it does not matter which of these participants sells it to you. Once your buy order is transacted at an options exchange, you own the option contract. The motivations of an investor to take the other side of your trade may be varied and may have no bearing on what you are trying to accomplish with your own investment. We will touch upon many of these motivations later in this course, and as you investigate the many option strategies available to investors buying and selling in the marketplace, you will come to realize just how versatile options really are. Remember that the investor purchasing either a call or put option is buying the right to either buy or sell shares of the option's underlying security. Again, this is a right that is being purchased, not an obligation. The person who sells the option, however, has incurred an obligation to fulfill its terms if called upon to do so through the process of exercise and assignment. The seller of a call option contract, also known as the writer, is obligated to sell underlying shares to a call holder or buy shares from a put holder if either of these holders exercises an option contract with the same standardized terms. If the option buyer chooses to exercise, the option seller will be assigned an exercise notice by their brokerage firm, calling upon them to fulfill the terms of the contract. Click on the video to learn more.
So what is assignment? Assignment is the notification that an option seller receives when a long option holder exercises the option. This is when the seller's obligation to perform under the contract kicks in. If a short call position is assigned, the writer must sell the stock at the strike price per share to the exerciser. If a writer of puts is assigned, he must buy the stock, the underlying, from the exerciser at the strike price per share.
Let's further clarify some terms that we've already covered in this module: buyer, purchaser, seller, and writer. Click on both the buyer and the seller to learn more. A buyer or holder is someone who purchases an option contract. Whether they are purchasing to create a new long position or buying back to close a short position is unimportant for terminology's sake. What is important is that the buyer controls the decision-making when it comes to their option as they decide whether or not to exercise. For this right, the buyer pays an option premium. It is also important to note that this premium represents the maximum risk to the buyer, something that will be covered later in this course. A seller or writer is someone who sells an option contract. Whether they are selling to create a new short position or selling to close a long position is unimportant for terminology's sake. What is important is that the seller is obligated to fulfill the terms of their contract. For this obligation, the seller is paid the option premium. It should also be noted that the options premium represents the maximum profit potential to the seller, something that will be covered later in this course. Now that you have a clearer picture of how options work, let's briefly review OCC's integral role in the marketplace. By definition, OCC is the common clearing entity, issuer, and guarantor for all U.S. exchange-listed equity options. OCC acts as what is commonly known as a central counterparty, or CCP. A CCP works through the process of novation, whereby the CCP essentially replaces the original contract or relationship between the buyer and the seller with a new relationship with OCC. The effect is that OCC becomes the buyer to every seller and the seller to every buyer. The buyer of a contract pays cash for an option, and in return, OCC guarantees fulfillment of that option contract, should the buyer choose to exercise. The seller of the option pledges to fulfill the terms of the contract, and for that obligation, OCC transfers cash from the buyer to the seller. By acting as the intermediary, OCC is able to guarantee fulfillment of the terms of the contract in the event that either party is unable to do so. When you buy or sell an option contract, it does not matter from whom you are buying or to whom you are selling. The options marketplace is one in which there is no permanent link between any one particular buyer and any one particular seller, but rather a new link with OCC. In addition, closing an option position in no way affects the rights or obligations of the original party on the other side of the trade. By acting as a CCP, OCC also provides stability and confidence in the markets by protecting against and reducing settlement, market, and default risk between parties. As a guarantor, OCC ensures that the obligations of option contracts are fulfilled for the buying and selling customers of clearing member firms, regardless of the financial condition of the contraparty or who that party is. OCC also technically issues all U.S. exchange-traded equity option contracts. The corporations on whose stock equity calls and puts are based do not issue these options. In addition, these companies do not participate in the selection of their shares as underlying entities for option listing. The individual options exchanges do this, so you might find options on a particular stock multiply listed or traded on more than one U.S. options exchange. Wherever they are traded, when an option contract is written and sold, it is OCC that actually issues the contract to the buyer. Further, options listed and traded on U.S. exchanges are fungible. This means that if a particular equity option is purchased or written on one exchange, the resulting position may be closed out with a transaction on the same exchange or any other U.S. exchange that lists and trades a similar contract. So far, we have introduced a variety of terms and concepts, such as buying and selling or holding and writing options, but there are other specific terms that describe these various transactions and their consequences, including long and short, opening and closing. Let's take a look at those now. Simply click on each circle to learn more. When we talk about being long stock or options, it can have two meanings, which may even seem contradictory. It can either mean that you have simply bought shares or options and you now own these positions, or it can refer to a bullish position, like owning shares or call options, because the position will likely benefit with rising market prices. However, you can also be long puts, which may seem contradictory in that put buyers generally look for the market to decrease in value. While it's important not to get bogged down with the concept of being long or short, it is important to know the distinction of the two terms. For most, the definition of being long is synonymous to ownership, which seems to suffice. And as the option owner, you are in the driver's seat as to what happens next. Click the tab below to find out why. As the option buyer, you have the right to decide what happens next. Do you hold the contract until expiration? Do you exercise at expiration or possibly earlier? Or do you simply turn around and sell your contract back to the market once it shows a profit or too big of a loss? The answer to all of those questions is entirely up to you. As the owner of the contract, the decision is yours. Some investors may wish to exercise their contract early to take advantage of a dividend payment, exercise at expiration to own or sell shares, or simply sell the option back to the market to close the position and take a profit. It may also be that the owner takes no action at all and simply lets the contract expire worthless. The point being is that as the owner, you are in control, and the price of that control is the premium paid when purchasing the contract. Just as a long position can be defined as someone who buys or owns a contract, it would then stand to reason that a short position is just the opposite. You can be short calls or puts simply by selling the contract, and by doing so, accept the obligation to fulfill the terms of the contract. In return for accepting that obligation, the option seller collects the premium paid by the buyer. And, similar to the long position, the term short has another definition as well. This one implies a bearish market outlook or position. If you own puts, sell calls, or short stock, you are likely looking for a decrease in market value and therefore short the market. However, being short carries with it its own inherent risk. Click the Assignment tab below to learn more. As an option seller, the investor is obligating themselves to fulfill the terms of the contract should they be called upon to do so. In return for accepting this obligation, the seller receives the premium from the buyer upon the execution of the trade. If the buyer chooses to exercise their contract, sellers will receive an assignment notice from their brokerage firm and have no choice but to fulfill their obligation. However, if the investor no longer wishes to hold their short position and thus be obligated, they can simply buy back their short contract to close prior to assignment, thus canceling out their obligation. An opening transaction is one in which you are either creating or increasing a position in a particular security. If you are purchasing an option to hold in your account, whether you already own a like contract or not, this is an opening purchase transaction. You are creating a long position. If you already own a particular option and purchase another just like it, this is also an opening purchase transaction. In this case, you are increasing a long position in that option. Conversely, if you are writing or selling an option contract, this is an opening sale transaction. If you have no position in this option, you are creating a short position. If you have already written an option and write another option contract with the same terms, you are increasing your short position in that option. Click on the video to learn more.
An opening transaction is one in which you are either creating or increasing a position in a particular option contract. If you are purchasing an option to hold in your account, this is an opening purchase transaction. You are creating a long position. If you already own a particular option and purchase another just like it, this is also an opening purchase transaction. In this case, you are increasing a long position in that option from 1 to 2 contracts. Conversely, if you are writing an option contract to maintain a short position in your account, this is an opening sale transaction. You are creating a short position. If you are short an option and write another option contract with the same terms, this is also an opening sale transaction. You are increasing your short position in that option from 1 to 2 contracts.
A closing transaction is just the opposite of an opening transaction. This is one in which you are either reducing or eliminating an open position in a particular security. If you are buying an option to either reduce or eliminate a short position, this is a closing purchase transaction. Conversely, if you are selling an option to either reduce or eliminate a long position, this is a closing sale transaction.
A closing transaction is one in which you are either eliminating or reducing a position in a particular option contract. If you are short a single option contract in your account and buy one with the same terms, this is a closing purchase transaction. You are eliminating a short position. If you are short 2 of the same option contract and buy one with the same terms, this is also a closing purchase transaction. In this case, you are decreasing a short position in that option from 2 to 1 contract. Conversely, if you are long a single option contract in your account and sell that contract, this is a closing sale transaction. You are eliminating a long position. If you are long 2 of the same option contract and sell one, this is also a closing sale transaction. In this case, you are decreasing a long position in that option from 2 to 1 contract.
Let's take a moment to make sure that you have understood some of the terminology we have covered so far. Match the terms on the left with the definitions on the right by dragging the terms to the appropriate definition.